The risk-on, risk-off strategy relies on a simple premise. Stay invested in equities to capture the market's upside, but rapidly retreat to the calm of fixed income the moment volatility strikes. The Global X Adaptive U.S. Risk Management ETF, known under the ticker ONOF, is built entirely around executing this specific maneuver. To time the market, ONOF uses a 4-indicator voting system. It tracks the 200-day moving average, a standardized drawdown metric, short-term momentum via the MACD, and market uncertainty measured by the VIX. The output of this complex machinery is completely binary. If 3 indicators vote to exit, the entire portfolio is violently shifted into 100% cash and short-term treasuries. 2 votes to re-enter, and the capital is slammed back into a cap-weighted basket of the 500 largest U.S. equities. The strategy is designed to protect capital. We need to look at the math to determine if this aggressive binary switching actually shields investors from loss, or if the friction of moving in and out of the market steadily bleeds away their gains. Highly marketed financial engineering often introduces a structural performance drag. The mechanisms built to manage risk frequently become the exact things suppressing growth. To audit ONOF's efficiency, we run it through Robbit and Bullpig. These are deterministic AI engines engineered to mathematically deconstruct fund performance and isolate structural flaws. Robbit evaluates broad strategic trends using end-of-day net asset value. Bullpig dissects the fund's tactical execution by analyzing 5-minute intraday tick data. The macro analysis immediately flags a severe inefficiency. The Robbit engine assigns ONOF a -5 efficiency score, projecting that a static, optimized, exchange-traded intelligent fund, or ETF, will outperform the active strategy by 22.48%. The data suggests that ONOF's heavily promoted adaptive signaling is acting as an anchor on its own returns. We will dissect the metrics to prove exactly how this logic fails at both the macro and micro levels. This chart plots the macro strategic return projection. The blue line tracks ONOF's actual performance, while the red line tracks the AI's ETF basket. The ETF model achieves a 55.50% projected return over a 650-day window, outpacing ONOF's 33.02%. That 22.48% gap expands steadily. The AI generates this excess return by completely ignoring ONOF's technical signals and refusing to shift to cash. Instead of actively toggling allocations, the engine uses unit normalization. It structures the required exposure into a transparent, static 100-unit basket. The AI isolates specific growth drivers to maximize the equity periods. It places 30 highly concentrated units into consumer discretionary and 16 units into mid-cap stocks. It balances that aggression with a permanent, static hedge of treasury bonds and high-yield corporate debt. By maintaining this constant defensive floor, ONOF's extreme exit triggers become mathematically obsolete. The metrics table quantifies exactly how detrimental ONOF active management is over a long horizon. Look at the first index. The static ETF basket captures an average of 10.64 percentage points of excess return per period over the actual ETF. This is not the result of a few lucky trades. The ETF outpaces the adaptive strategy in 99.84% of all measured periods. The active fund almost never takes the lead. At the macro level, the conclusion is absolute. ONOF's complex timing rules fail to match the wealth generated by a static, rigorously optimized factor allocation. A fund can suffer from poor macro strategy, but it can also bleed alpha through poor intraday execution. We have to examine the micro view. The Bullpig engine processes high-frequency 5-minute intraday tick data. It identifies execution drag and isolates specific factors driving the market at any given moment. This is the tactical return comparison. It tracks ONOF against a newly generated factor model built for high-frequency execution. The factor model posts an 18.82% return, compared to ONOF's 11.65%. The AI secures a 7.17% tactical advantage. The engine locates this extra yield by identifying a concentrated recovery and growth pattern operating within the broader market. The circular chart breaks down the exact DNA required to capture that tactical alpha. The AI weights the portfolio heavily toward momentum, allocating 41 units to home builders and 20 units to technology. ONOF cannot execute this type of precision targeting. When its delayed indicators finally signal a re-entry, the fund is required to buy the entire cap-weighted S&P 500, exposing capital to lagging sectors while diluting the actual momentum drivers. The Bullpig metrics confirm that this lack of tactical precision is a chronic defect. The targeted factor model beats the broad active ETF in 9,277 distinct 5-minute trading periods. That equates to a 92.77% historical win rate. Broad index exposure triggered by lagging technical signals is a mathematically inferior approach to the market. ONOF bleeds tactical alpha 9 times out of 10. The data from both analytical engines aligns perfectly. ONOF's rigid adaptive rule set actively limits its own profitability. Binary risk management creates an illusion of control. Switching between 100% equity and cash creates inefficient returns compared to steady, factor-based approaches. Because indicators like the 200-day moving average and MACD are backward-looking, the fund exits and re-enters late. It suffers whipsaw friction and reliably misses the most critical high-growth recovery days. Complex signaling mechanisms are highly effective at selling the concept of downside protection, but the math proves they fail to deliver optimal capital appreciation. For institutional asset managers, the data presents a clear mandate. There is no need to engineer convoluted volatility triggers to compete in the smart beta space. Institutions can utilize engines like Robbit and Bullpig to systematically audit competing products. They can bypass the marketing, isolate the exact market style, and identify every structural leak. The output of that analysis is the exchange-traded intelligent fund. The ETF acts as a transparent glass box replication of the target style. By normalizing the assets into a straightforward 100-unit basket, it secures the necessary risk exposure while discarding the friction of active management entirely. Deterministic AI eliminates behavioral delays and technical latency. By calculating the optimal mathematical path, the engine locks in and holds it. It reduces the complex, opaque promises of heavily marketed ETFs into an executable mathematical certainty. True risk-adjusted alpha is not achieved through rapid, binary market timing. It is built on transparent, rigorously optimized, and persistent factor allocations.